What I want to do is share some insights on our income fund, which we're really excited about at Solaris. It's a fund that's been designed specifically for retirees, and that means individuals on a 0% tax rate or a 15% tax rate to take advantage of the franking that we're generating in the fund. So we're focused on a really strong level of income generation, but also on capital growth and total return. So I can touch on that shortly. In terms of today, why equities? Why do we recommend and why are equities a great place to look for retirement income? Our approach at Solaris, and then some insights on what is happening in terms of the income investing landscape in Australia at the moment. So why equities? The market this year has just kept moving forward. It's had a lot thrown at it. Tariffs, Trump, wars, shutdowns, big sell-off, big rally. All it's had that hasn't had is the kitchen sink thrown at it, but it's continued to move forward. And that's not abnormal in the Aussie market. There's always a headline, there's always something happening, there's always a concern that is thrown at the equity market. And this is a 1 year period full of a lot of noise, which is a constant in the Aussie market. So there's always a level of noise. If we take a step back, a longer term perspective here is going back to the start of the era of franking, and it's the same over longer term periods. You can see that we were zoomed right in here on the top right, a noisy period, a noisy year, but that level of noise is always consistent in the market. There's always a concern, and the market continues to move forward. So the index over this period of time up fourfold, 400% in terms of capital growth. But what I want to do is, I just want to take away the noise and to have a look at the underlying level of income that is generated by the market. So going back to the start of franking, around 50 cents a year, and that dividend growth coming passively out of the market is far more stable. It's far less noisy, and it's far more consistent. So there's this trend line of dividend growth in the market that is growing at above the rate of inflation over all the different time windows, over 5-10 year windows. So that helps protect the purchasing power of those dividends, but it's a good asset class generating that level of income that is far less noisy than at the headline. And on top of that, it's got the benefit of franking. So that 0% tax rate investor can't get franking out of other asset classes, but it's sitting on top of this cash income each year, which is a really powerful proposition for income. So we like the Aussie equity market, good levels of underlying income that is far less noisy than the top line. So how do we do it? We've generated a yield since inception of 8.4% per annum. So that's a really strong level of yield, but we don't just focus on the dividend yield alone. And this chart is going to help explain that. So I've just sorted the top 200 stocks based on dividend yields, low yields on the left, high yields on the right. A big portion of the market's got no dividend, and you've got this huge selection of stocks in the middle that have got a good level of cash income. It's got franking on top. But what we're not doing is loading into these stocks on the right-hand side of the chart. A lot of the really high dividend yielding stocks have got declining dividend per share profiles, so the dividends are going down. They've got generally high levels of debt or some sort of issue going on with them. And from our perspective, we are very focused on that income, but also on the capital growth outcomes. These stocks generally underperform the market in terms of total return and in terms of capital. So if we'd got the 2026 highest yielding stocks and held them, they've underperformed the market over the past year by 15%, which is a massive cost. And if that strategy is repeated, it's very poor in terms of capital and total return, which is really what we're focused on as well. So our approach, looking for very healthy, good levels of income, that 8.8% range, where we're seeing the potential for capital growth and total return. We've delivered that quarterly throughout our inception, and I can touch on that, along with good total return and capital growth outcomes. So some stocks. This will help give it a little bit of colour. I've chosen 4 holdings here to help highlight our approach a little bit better and to give it some colour. And the first one, I'm at the risk of repeating myself. I was up here in 2022, 2023 and 2024 highlighting Suncorp, and Mark's laughing. It's a stock that we were buying between $10 and $11 a share. It's generated $2.54 in terms of cash dividends that are fully franked, so there's a franking on top, and it's given a $3.15 capital return as well, and it's now trading at $21.50. So we're investing for that income, really good levels of income, where we see that potential for capital growth. And Suncorp's an example with both that income realised and capital growth. So very good outcome. Fortescue's a more recent position. Fortescue's a company with a really good level of cash income. They're generating a lot of profit. They're paying a lot of tax. They're generating a lot of franking credits. And the balance sheet has no debt on it. They've got a very strong balance sheet. What's unique here with Twiggy and the management team is they've started to dial back their spending on these big green energy projects that have got really questionable rates of return attached to them. And we're seeing the potential that more of that franked cash can start to come back to shareholders into the next period. So over the next year, 18 months, we're seeing the potential for higher cash dividends, larger amounts of franking, and the stock's trading on a PE of 11 to 12, so the potential for capital growth if they can deliver on that as well. So very good levels of income in these stocks. This is our income fund I'm talking about. So why am I putting up a stock here, Life360, that has got no dividend? And it's trying to articulate our focus on total returns. It's not just about that yield, it's also about the capital growth. And Life360 is an amazing company that we were buying between $5 and $6 a share, and it's now trading at $45 a share. So it hasn't given us dividend income, but it's delivered a really good amount of capital growth in our income fund, which is a very important focus for us. We're meeting with Chris, the CEO and founder, last week and trying to explain that we don't want a dividend coming out of Life360. We want that cash reinvested to generate higher levels of profit and income and capital growth into future periods. So we're very happy to hold stocks that have got no dividend income in our income fund. The next one's Goodman. What's rare in the Aussie market is the ability to invest large amounts of capital at high rates of return. And Goodman is sitting on this industrial portfolio of sheds with the ability to invest capital and turn them into data centres, generating large amounts of potential future profit, so capital growth. And it's another key portfolio holding. Now, we're not just sitting here investing in these growth stocks and sacrificing on income. We are generating good levels of income above market, so over 7% income and 8.4% since inception. And we're doing it with this combination of investing in companies where we see really good levels of capital growth. So a really big dual focus of ours at Solaris. So with what's happening at the moment, that was a good update on how we approach it, some stocks. This is what's happening in the market. And maybe the speakers earlier were touching on it too, but investors are desperate for yield. There's a massive area of the market in bank hybrids that are rolling off, and quite a few Aussie stocks are starting to show that there's a lot of crowding and it's pushing the dividend yields right down. So CBA, we're very cautious about and avoiding at the moment. Wesfarmers as well, they're very crowded. Those stable dividend yield profiles have got pushed up to stratospheric levels of PE, and it's very risky from our perspective. We do know there's a lot of franking still getting generated in the market. So Fortescue's sitting there generating huge amounts of franking, and so are a lot of other stocks. And that will come back to shareholders through the Aussie equity market. So that franking is very advantageous to that retiree, in the hands of the retiree. What we're seeing is that dividend announcements are getting amplified. So after a stock announces a dividend or a special dividend, that run-up is getting amplified, and we have a process and team and framework at Solaris to take advantage of that. So I want to touch on what's happened here. Off-market buybacks did get banned in October 2022. So a really efficient way of returning that franked income is now banned. And since that period of time, I've got a basket of the 24 special dividends that have been announced. And this is the return of the stocks relative to market. So you can see they trade largely range bound, a little bit of dividend run up into that announcement date, and then bang, they're up 5, 6, 7, 8, 9%. So if you're waiting for that announcement, waiting for it to hit the ASX, it's far too late, because whether it's ETFs or investors that are really desperate for this franked yield are coming in and ramping the stocks up far too high, but far above their fair value. And what's happening after that period of time is they're underperforming the market materially over the next 45 days. Our approach at Solaris is we are fundamental investors. So we're meeting with companies, we're going through reporting season, talking about their plans for capital management, their potential to generate special dividends, and we have a process where we invest 30 to 40 days ahead, and we can harness that capital growth, we can receive the income and franking. So we're very focused on that 30 to 40 day holding period. If we miss it, no worries. Through to the keeper, we'll move on. What we're not doing is buying up here after the announcement with all the ETFs and yield chasers and holding for the next period, because we know it's going to be very detrimental to total return outcomes. So our process and team and framework at Solaris enables us to invest ahead. Roughly 12 of these we've picked ahead of time, and we've let the others go, because we are really focused not just on receiving that income from the special dividend and franking, we're really focused on that total return. So a different approach at Solaris. In terms of income, very good outcomes over time periods. What we're focused on doing is generating more income than in the market. Stocks like Commonwealth Bank are trading on a very low yield. We don't think that is smart. In our fund, we are focused on other areas of the market, more in that middle ground of stocks that I had up earlier of the selection, and generating 7 to 8% yield over the past year and 8.4% over the longer term. So a good level of income. The total return sort of speaks for itself. Income, very good levels of income, especially relative to the market, at 8.4 relative to 5.6%, so material amounts of income and franking, and total return. So a real focus at Solaris, and what I'd like to do is just in summary, highlight why we are focused on the Aussie equity market for retirement income, longer term journeys, harnessing that potential capital growth over time through productive Aussie companies, that more consistent level of cash yield each year, and then the franking on top. We've got a process where we're focused on not just good levels of income, but also capital growth and total return. And then a real competitive advantage in taking advantage of this shift in the market and this hunger for yield in getting ahead of these special dividend announcements through our fundamental analysis and framework. So a quick overview, and thanks for your time today.